Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
It's a pivotal week for rates and risk. Stocks are hovering near record highs. The bond market awaits Goldilocks confirmation. Digging in, the yen rallies after BOJ Governor Ueda doubles down on rate hikes. T. Rowe Price says brace for a shock. And mounting tensions, protesters and strikes hit critical levels in Israel. Prime Minister Netanyahu stands firm on his ceasefire terms. Good morning, Manus. Great to be back with you.
Danny, good morning. Good to have you back in the seat alongside me to debate the jobless claims, the jolts, and of course the pivotal, the crescendo is going to be the jobs report this week. 165,000 is what we're going for, just off our all-time highs. JP Morgan warned that even if you get rate cuts coming down the pike, it's not going to be enough to propel equities higher. Boeing this morning, keep an eye on that. You've had Wells Fargo downgrade the stock to $119. Again, a lot of turbulence in the airline stocks. We'll talk about that in just a moment. Cathay Pacific investigating some of their gear. Bond markets, 390 is where we are. 4 months of gains. Longest run since 2021. Can that extend? And then yen. This is dollar down, yen rallying because Ueda writes a letter to the government saying, yeah, you know what? I'm reiterating. I'm going to keep lifting rates. The accommodation, the environment is still accommodative. Danny, that's the state of play.
And it gives us this PTSD of what happened last month, Manus. And I think that's why this week is just so pivotal. We have ISM manufacturing today. Remember, this was the piece of data that was so weak last month that it kicked off this chain of events that eventually saw the yen strengthen to a tremendous degree, that saw Japanese stocks plunge, and we've almost erased that memory of it. So what's at risk? Is it an asymmetric risk, the fact that you have stocks, as you pointed out, near all-time highs heading into this week?
Look, do we get a whiplash, a redux of the whiplash that we had at the beginning of August? And again, it's interesting you see this piece from T. Rowe Price talking again about the potential for a further unwinding in the carry trade in the yen. But the question is whether the data comes in a little bit hotter, a little bit better than everything that we've expected. And therefore, the narrative for a 50 basis point cut is perhaps wounded. That is the potential double side of that risk.
Well, Mike Wilson from Morgan Stanley also points out that this is critical for equities this week, too. That either you have a strong job numbers and you say, OK, those high equity valuations are fine, or you get a weak print and say, OK, it's time for another little growth scare. Again, like last month. And it is a data-packed week. So, I mean, it's just to lay out what we have. Manufacturing PMIs later this morning. Then we'll get jolts on Wednesday. We'll get jobless claims and ADP plus service PMIs on Thursday, with all roads leading to payrolls Friday. Joining us now is Aneeka Gupta, Director of Macroeconomic Research at WisdomTree. Aneeka, always a pleasure to speak with you. How do you prepare for a week like this week, for a jobs day of this Friday like we're about to have?
Very good morning, Danny. Yes, it's quite a pivotal week with the the economic data coming in, and obviously Friday is the all-important data print. In our view, we still believe that we should see a bit more strength coming in this jobs report compared to last month, with average trend growth in jobs hovering around the 160K level versus that 114K that we saw last month. And that's because there were a number of factors that did derail the numbers last month. And I think that should allow for a bit more of that stability to come back into markets. Obviously, there's the other side of the trade is if we do get a much weaker print, that would, raise concerns over growth caution. And then, you could see a greater likelihood of a wider pace of cuts taking place by the Fed.
Aneeka, good morning to you. To ensure that perhaps a soft landing is delivered, do you think that they will go to prevent a serious deterioration in this economy? They'll go for the 50 basis points and front load?
I don't think so, Manus. The economic data that we've seen so far coming out of the U.S. has been relatively strong. If you even consider the GDP print that was revised higher, our expectation for the upcoming, jobs report is to see that stability come back in versus the weaker print last month. And that just tells us that it's paving the way for a 25 basis point cut. Clearly, the direction at Jackson Hole, paved out by Jay Powell, has been for a more dovish pivot. Yet there was no clear inclination that that they need to go as far as 50 basis points at this point in time.
Given they don't need it, and some of the resilience of the economy, Aneeka, I just wonder what you make of what markets have been doing recently, and that is more defensive type equities leading the way. Utilities have been the best sector over the past month. Healthcare staples have done better than tech, and gold has been on this incredible streak as it continues to notch new records. Clearly, somebody is worried about something. Is that worry unwarranted?
No, it's not unwarranted. It's very much present in the market. We do have equity valuations at all-time highs. There is that concern of U.S. elections and the risk that will be, coming into the markets on the basis of those results. What we are seeing is really interesting because what investors have been used to over the prior 2 years has been an inverted yield curve. And clearly, what we're seeing now is that the disinversion of the yield curve, and that has very important ramifications. First and foremost, you're seeing the shorter end of the yield curve begin to come down at a much faster pace, whereas the expectation for the longer end of the yield curve is likely to remain where it is. And that just tells us that the discount factor within equities, which is so reliant on the long-term rate of the yield curve, is likely to stay where it is. And that means that longer duration growth stocks are likely to be more penalized as compared to value and small cap oriented stocks that tend to be priced on the shorter end of the curve. They are likely to have an asymmetrical benefit compared to longer duration stocks. And that's what we're seeing play out. So if you look at the comparison of equal weighted S&P 500 versus the market cap, you're seeing, a much stronger bounce of the equal weighted S&P 500. As you mentioned, if you look at more of the defensive stocks, they're also benefiting at this point in time. So you're seeing a bit of that catch-up trade take place as investors just, try to understand this period of uncertainty and this recuperation that we got from the sell-off at early August.
Yeah, let's hope we don't have this similar whiplash again. Bonds have been on a tear, 4-month rally. The question is whether that's exhausted or fully priced for the series of rate cuts.
Absolutely. I mean, one way we are seeing that being played out is in gold. So safe haven assets such as bonds as well as gold are performing very well. We've seen, even though we've begun to now see a bit of a pause in the central bank buying by China, Turkey and India are holding that strength, and we are seeing tremendous amount of demand coming in from these two central banks and acting as a very important anchor for gold prices. And now that, the broader consensus view is more bearish on the dollar, that again is another very important tailwind for gold as a safe haven asset.
Aneeka, I guess what I'm trying to understand is in all of this, if this is a catch-up trade or if this is the regime shift that people have long awaited to happen if it is finally here, which of the two does it appear to be?
I think it is a regime shift. It started off with the great rotation out of large cap growth into value and small cap. We saw a bit of a pause when there was this, strong sell-off that took place in the market. And now that we've seen, equity valuations recuperate somewhat to that level that we had initially seen, in that recuperation, we're seeing that great rotation trade continue to play out. So I think it very much is a defensive plus, looking at undervalued segments of the market that stand to benefit as we see that disinversion of the yield curve take place.
Well, one thing for sure is that the banks have had a pretty good run. And the question is, as we go into the cutting cycle, whether that endures, Aneeka.
Well, there are two factors for the banks. Clearly, it's obviously rates play a very important factor, but also the growth outlook in, respective economies. So if growth is in line with a softer landing, banks still stand to benefit. However, if we do see a sharper, more protracted slowdown, then that will impact banks, and we will see, a knock-on effect in the performance of the banking sector as well.
Well, it certainly will reduce the cost of deposits. Aneeka, thank you so much for being with us. Aneeka Gupta there of WisdomTree, setting the agenda this Monday morning. Other stories trending on your Bloomberg terminal, this is what we've got. Volkswagen is considering factory closures in Germany for the first time in its 87-year history. After years of ignoring overcapacity and getting worse at competing, the German auto giant's moves are likely to kick off a broader reckoning for the industry as Chinese rivals overtake their European car makers.
Now, meanwhile, VP Kamala Harris joined President Joe Biden in declaring that U.S. steel should remain domestically owned and operated. It's just the latest headwind to this proposed sale of the company to Japan-based Nippon Steel.
Tesla plans to produce a 6-seater variant of its Model Y car in China from late 2025. That's according to reports from Reuters. Tesla has asked suppliers to prepare for a double-digit increase in the Model Y output at its Shanghai factory.
Now, coming up, tensions are still high across Israel. Prime Minister Netanyahu has been pushing back on protesters' demands for a ceasefire. We're going to have more on that next.
And the bar isn't too high for a 50 basis point cut. That's according to Mark McCormick of TD Bank. He joins us a little bit later this hour. Context matters on Bloomberg.
We say yes, they say no all the time, but they also murdered these people. And now we need maximum pressure on Hamas. I don't believe that either President Biden or anyone serious about achieving peace and achieving the release would seriously ask Israel to make these concessions. We've already made them.
That was the Israeli Prime Minister Benjamin Netanyahu standing firm as hundreds of thousands of protesters took to the streets over the government's failure to secure a ceasefire for hostages deal after 6 Israeli hostages were found dead. President Biden told reporters in Washington he planned to speak to Netanyahu eventually, with the Washington Post reporting over the weekend that the U.S. plans to present a take-it-or-leave-it ceasefire deal to all parties soon. Joining us now for the U.S.'s reaction is Bloomberg's Amory Hordan. Amory, good to see you this morning. It sounds as if this was a fairly pivotal week inside Israel and externally. Is Netanyahu doing enough? And a one-word answer, and then he went inside. President Biden responded no.
Yes, and he met with his national security team and those individuals that have been flying back and forth to the Middle East, meeting with Qatari and Egyptian officials to try to negotiate this ceasefire. One of those officials, an individual part of this negotiation, speaking to the Washington Post, said, you can't keep negotiating this. This process has to be called at some point. Does it derail the deal, given the events over the weekend with those 6 hostages found dead, with the fact that Israel, the United States, saying they were shot dead, those captors by Hamas? Does it derail the deal? No. If anything, it should add additional urgency in this closing phase, which we've already been in. We've heard this a lot, though. So does the context change the fact that potentially could a deal get over the finish line now? The United States is calling this take it or leave it. We do know that the head of Mossad was actually in Doha yesterday. So potentially reading the tea leaves, maybe things are pushing forward in terms of a deal. Netanyahu is under a tremendous amount of pressure when you see those pictures out of Israel yesterday. Protests on the street, labor strikes, people not wanting to go to work. They want to see something done.
And meanwhile, in the U.S. in general, it is this last gasp, this last stretch for campaigning until the election. I know Libby Cantrell, whenever she's on with you, always says, Anne-Marie, don't pay attention until after Labor Day. Here we are after Labor Day. What does it mean for the candidates and for campaigning?
Well, basically, pollsters will say that people's minds start to become more focused after Labor Day. Summer holidays are over. Kids are back to school. They can start paying attention and thinking about who they're going to vote for. We should also note that starting soon, you can vote early in some states. So it is full-on election swing. 9 weeks today, November 5th, is when Americans officially go to the polls. So you have this race that's basically frozen right now in the polling. You could see Harris in our latest Bloomberg Morning Consult poll. She's really closed that gap that Biden was unable to attain when he was in the race. And she's ahead in some of these states, but within the margin of error. And even yesterday when she was in Pennsylvania, clearly making a play for those Union Joe voters, talking about how U.S. steel needs to remain domestically held in U.S. hands, you can see the fact that she said, don't believe the polls. This is going to be tight. This is going to be neck and neck. Don't believe the polls. Don't believe the enthusiasm just yet. You have to go out and vote.
You're right. She really did go after the working vote. This is going to be a fight for the future of every worker has the right to organize. So it really is playing in to the union's hand. What cuts through in that blue wall? What is it that really cuts through in Pennsylvania?
Well, I think it was obvious where she was yesterday on Labor Day. She also made a play in Detroit, Michigan.
Yep.
That is about car manufacturers, the UAW. This is something that Trump has gone after this administration because they have made a push to electric vehicles, which has unnerved some of these rank and file union workers who are concerned about their future job prospects. And then she went to Pennsylvania, where she talked about not just to steel workers, but also this is a place where Republicans will criticize her for flip-flopping.
Yep.
You know, she made that famous quote, "I'm against fracking." She's now walked that back a number of times. Those statements are key to places like Pittsburgh, to places like Detroit.
Anne-Marie, really appreciate it. Bloomberg's Anne-Marie Horder, who will, of course, be back in about 40 minutes' time with the surveillance gang. Okay, coming up, Cathay Pacific cancels some Airbus flights amid engine component issues. We're going to have the details for you on that next on your brief. It's your Bloomberg Brief. Danny Berger and Manish Cranny in New York. Shares of Rolls-Royce, an absolute roller coaster ride this week. They're bouncing back up some 3% this morning, but they dropped more than 6% yesterday. That's the most in 2 years. Cathay Pacific had canceled multiple Airbus flights to inspect engine component issues, and Rolls-Royce has been moving on it because they are the maker of the engine in question. Bloomberg's Benedict Campbell joins us now from Berlin on more on this. Benny, how much should we understand this as a Cathay issue or something gone very wrong at Rolls-Royce that balloons into something much bigger?
Yeah, that is really the big question at this point. When the headlines first crossed yesterday, and you just alluded to the investor feedback, obviously people were a little bit spooked and were wondering, is this an industry-wide issue that will affect not just Cathay and their fleet, but airlines across the world? This is a fairly widely flown plane at this point. There are about 1,500 of these engines out there, mostly on the smaller variant, the A350-900. But Cathay said that it affects both types, the 900 and the 1000. For now, it appears that this is contained to Cathay, but it's early days. We've just sent some headlines that JAL, the Japanese airline, they're inspecting their planes. Lufthansa, for instance, they said that they're closely monitoring it. Qatar Airways is a big operator of this plane. So that's sort of what we're doing right now. We're running through the checks. We're running through the airlines. Nobody's come out since to say we found similar issues. Potentially, the good news is that this is contained to Cathay. Also, that it's something that's fairly easily fixable. They don't have to take the engines off the wing. The turnaround is relatively quick, it seems. They've been able to repair some of the engines already. So all of that points to this issue being maybe more annoying than catastrophic. And you can see it in the Rolls-Royce shares today. They're up marginally again after that fairly epic drop last night. So it seems like investors are hopeful this can be contained.
So, Benny, the word there is contained, and therefore the question is about risk to Rolls-Royce and Airbus. If we're in containment zone, that risk is lower.
Correct. I mean, but the other thing you have to remember is Rolls-Royce is a stock that's sort of prized for perfection. The shares tripled last year. They're up a lot this year again. And the narrative around Rolls-Royce was that this is really a company in a positive turnaround and a good story to sell. The A350 was selling well. They are the sole engine supplier on that aircraft. They really are getting costs under control. So anything like this, where people are spooked and maybe are reminded of past issues on other engines, that's something that they don't want. So if they can contain this, then great.
Benny, thank you very much. Benny Campbell in Berlin on the latest there on the Cathay Pacific story. Other stories on the front pages. This is what we're tracking for you. First up, Bloomberg. The U.S. drafts sanctions against Venezuelans over the disputed vote. Treasury Department close to announcing 15 individual sanctions on the Maduro-affiliated officials. Additional visa restrictions are planned by the State Department.
Now, Manus, this on Axios. The Brazil X ban has been upheld by the Supreme Court panel there. Musk has been refusing refusing to comply with the law. It was a unanimous ruling, and Musk also accused the country's top judge of acting as a, quote, dictator for suspending X over misinformation concerns and failing to appoint a legal representative for that platform.
The FT leads with the story on housing costs. This is big in the political narrative here in the United States in the election. Housing costs rising to a record high across nations. More concerning than healthcare or education. Half the respondents in the OECD nations are dissatisfied with the availability of housing, and this, of course, is all from Gallup. And as I say, it's a big political issue here in the US. Think about house prices. Average house prices nearly 40% higher since Biden took office in 2021.
And a huge part of the problem, as this article lays out, is just supply. And that's what makes policy so difficult. Anything that really stimulates demand could be an issue if you don't have supply alongside it. Now, Harris, for her part, has tried to tackle both sides of the issue, saying we're going to give tax credits to basically fuel more housing development, but at the same time give first-time home buyers a subsidy. And that's where economists are concerned.
Yeah, I mean, the promise is, and these are promises, which is $25,000, maybe bringing another million potential homeowners in there who can't get on that housing ladder. But can you construct 3 million new housing units and really push Wall Street aside from that deal? We can debate that.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny. Let's set your agenda.
It's a pivotal week for rates and risk. Stocks hover near record highs. The bond market awaits Goldilocks confirmation. Digging in, the yen rallies after the BOJ governor, Ueda, doubles down on rate hikes. T. Rowe Price says brace for a shock. And mounting tensions, protests and strikes hit critical levels in Israel. Prime Minister Netanyahu stands firm on his ceasefire terms. Danny, welcome back. Good to see you. And we have big risks at play this week.
We do. Summer has certainly come and gone. And it is a binary risk with jobs data this Friday. Mike Wilson at Morgan Stanley saying that it is a key determinant in whether equity valuations hold up. We're about a third away from all-time highs as of the close on Friday. We dropped by nearly 0.5% this morning. Clear nerves in this market. Your U.S. 10-year yield, little change, but both bonds and equities are on a 4-week winning stretch. Will this week confirm or deny that? U.S. dollar versus the yen, weaker by about 0.7%. Manus, as you mentioned, it was a letter to the government basically saying we are going to hike if everything goes to plan. So those concerns about volatile markets derailing them, that is not the case. So again, you get that strength coming from the yen again this morning.
Yeah, well, it's a question of deja vu, isn't it? Whether we go back to what we had in the very first week of August, which was a jolt, excuse the pun, from the jobs report, and then layer on top of that a carry trade which unwound really quite aggressively. And if you look at this week's numbers, Danny, it's a question, you got the yen in play at the start of this week. You're counting down to the jobs report. And we've had those adjustments in the month of August, nearly 1 million jobs less than we anticipated. So it's about veracity of data as well.
There is something different in this market heading into this report versus the last report, though. And that is this series of defensive plays coming into the fore. You have utilities, the best performing sector in this equity market over the past month. You have gold on a run. So people are worried. It is not perhaps as sanguine as it was last time around. Yeah,
there's a little bit more breadth. I mean, one thing last week, it was very much about the rotation, the equal weight, hitting record highs relative to the tighter measure of the S&P 500. So it's a question of whether rate cuts come into play. Do you go for value and breadth, which is the conversation we had with Aneeka just a short time ago.
It certainly is. And again, Manus, as you point out, the other important conversation this morning is the yen and whether we get some sort of redux of what happened last month. Let's get over to Bloomberg's Ven Ram on this, our currency analyst within the Bloomberg house. So, Ven, you have this concern that, yet again, we could have another volatile yen, that all of the concern of last month has gone away and we're right back where we are. How much does Ueda telling the government that we could hike again put into risk the carry trade?
It does imperil the carry trade a whole lot, Danny, morning. And summer has come and gone, yes, as you mentioned. But the market's complacence hasn't gone anywhere because, the Bank of Japan is very clearly saying that, look, they are going to hike rates. Why do they want to hike rates? They want to hike rates because real rates in Japan are pretty deeply negative. If you look at the 5-year real yield in Japan, it's south of 105 basis points negative. So that negative real rate is not a good thing for an economy that is growing at a pretty decent clip and where inflation is doing its rounds. So the Bank of Japan is very keen to raise rates, and all this talk about market volatility is not their concern. Of course, they may have come out and assuaged some fears, but that is just addressing sentiment on the day. If you can't rely too much on that, the Bank of Japan's policy remit is to guide the economy and make sure that inflation is well anchored, and that's what they're trying to do. And therefore, the risk of an unwinding of the carry trades remains and is going to be the emerging, if not the emergent theme in the next quarter.
Well, we're certainly going to debate whether there's another wave of structural flow to repatriate into Japan. We're counting down to the jobs report this week. You're going to get jobless numbers, you're going to get JOLTS, and then it's the non-farm payrolls. The risk is that this is lighter. As Danny says, it could be binary for the market. How binary can it be on Friday?
Well, I think the number that's going to do it for me, Manas, is jobless rate. If it ticks higher than the 4.2% forecast, then the Fed is going to be pretty upset about it, because that means that the labor market needs some rescue effort, and that is what they will provide. The question really is for the markets is whether it's going to be a 25 basis point move or a 50 basis point move. Looking before the data, it looks like 25 basis points is what we should be aiming for. But, if the jobless rate ticks higher, then that is going to put a sense of urgency to the Fed as to how high the rate is in relation to where the economy is.
OK, Van, we're counting down. We'll track that data through the week. Van Ram on the FX markets. Our guest this morning is Mark McCormick, head of FX and EM strategy at TD Bank. He weighs in on the Fed's path ahead, writing this. The main risk is our view is that the Fed leadership finds itself needing to go back to neutral stance sooner than we anticipated. We no longer view the bar for 50 basis point cuts as overly high for the coming meetings. He joins Danny and I now. Mark, Danny used the word binary. Let's get to the data on Friday. Is it fill or kill? Is this one single piece of data, fill or kill, for the 50 basis point cut to come true in September?
Yeah, I think absolutely. I think this was, if you go back to the last report, it was the straw that broke the camel's back in terms of where the markets went in terms of volatility, what it was thinking for the Fed. It basically pulled in four cuts for this year, almost 4 cuts and change for next year. So this report is going to be quite pivotal just because we know that Powell has acknowledged that they're ready to cut. And now the market's trying to figure out, can we do 25? Can we do 50? But I think the market also has to be mindful. It doesn't want to drop the ball on inflation. The Fed's done a lot of work on inflation, and there is a little bit of a divergence here between sticky and flexible inflation, which is also something to keep in mind as well.
Well, Mark, I know you think that macro volatility is still too low and that the carry trade will continue to underperform. Why is this a market that's ripe for disruption?
I think a piece of it is that markets have gotten complacent again. I feel as if markets are, especially the FX market, it's known as a serial monogamous. It can only focus on one theme at a time. And the theme that the market's focused on is only the U.S. And this is what I think is interesting about the currency market is it's always relative. So you've got to compare one thing to the next. The U.S. has slowed, and a lot of the leading indicators that we track, data surprises, data trends, consensus revisions, they all justify that things have moved in a direction where the Fed can get out of restrictive. I think what the market's missing, and it's completely ignored, and we got this view when we were in Asia visiting clients as well, is that maybe the market's adopted to a very slow growth in China, but all the other pieces outside the U.S. are connected. European export growth is connected to China. China is connected to other parts of the world. And I think what we're seeing is that the impulse from these other places is much faster deceleration than what we're seeing in the U.S. economy. And also, if you look at the global manufacturing cycle, it's also very weak and it's decelerating. So I think a piece of it here is you still have a tremendous amount of uncertainty. The French have to deliver a budget to Brussels this month or early next month that's likely to be rejected. We just saw the elections in Germany, which moved into an uncertain direction. And we also have the U.S. election as well. So if you take where our models are at in terms of volatility, we're kind of back to this rubber band metaphor where if you start to pull things a little bit too far, when they get a pop. And that's what we're starting to see is the market's got very complacent. I think over August, our positioning and our short-term valuation models are skewed, and we are just not priced for any surprises again.
It's interesting that you talk about we're not paying enough attention to those global issues in Europe and in China. If there is a synchronized slowdown, more aggressive perhaps than we are anticipating at the moment, how will that reverberate to the dollar?
So I think a few ways. One, it's going to be good for the dollar, particularly against the euro. I think this is one of the ones where markets kind of get a little bit over their skis. The pendulum goes too far in one direction. Again, we focus only on one theme. If you're just focusing on Fed pricing, the dollar's still cheap on rate differentials. If you're looking at global growth dynamics, the dollar, again, should be stronger. And again, I think a lot of this boils down to maybe their central bank reserve diversification. They're not price sensitive. They kind of come in the market, do what they need to do, but they're not really driven entirely by fundamentals, so they can move things a little bit too far, too fast. So I think the big trades are very simple. One is that we are short Kiwi. New Zealand dollar right here looks very ripe for a correction. You've got a local slowdown. You've got a central bank that's very aggressive. And again, it's got a high beta to the risk in the dollar. So the way we're looking at this is we are short euro dollar through a put spread. Gives you a little bit more time over a couple of months to play through some of these events. But we do like New Zealand dollar. So it's basically a function of picking currencies that are sensitive to risk, sensitive to global growth, and just don't have a great local story. And those are the ones where the dollar should rally. But the other side of this trade is essentially to be long on G10 crosses.
What are you doing with the yen then? T. Rowe Price telling Bloomberg that they think another shock is on its way with a BOJ that is willing and wants to hike. Are you preparing for a shock, Mark?
Yeah, we've been out of consensus on the BOJ all year. We were expecting the BOJ to hike in July. We expect them to hike again in the fall. I think it's very clear if we kind of go dust off the playbook from a couple of years ago is every central bank that started was behind the curve. Neutral rate was higher than they thought. They had to go until something kind of broke a little bit and then kind of try to walk things back. And BOJ is in the same position. And again, as we talked about, I think last time as well, is I think there's a concerted effort by the government, by the pension funds, by the central bank to get money back into Japan. So the BOJ's got to raise rates to assist the pension funds to repatriation. And again, I think that would all help to normalize the currency. So I think, what's critical is that they're ready to go. And as they highlighted, central banks are always going to tell you when there's a shock that shock can stop them. But that is, again, just a moment in time for them to kind of suggest and try to clear market anxiety. But to me, the fundamentals, medium term, longer term, all suggest stronger yen, more BOJ action. And again, further undermining of the carry trade, which is one of I'd say our highest conviction is we need more vol. We need more defensive markets and through the fall, and that the carry trade is going to continue to suffer. And it's more of a structural flow, not a tactical position that people are just going to unwind in a month or so.
Can you just build on that structural flow? Because that's the point that T. Rowe Price made. It's a structural repatriation back into yen, but that's not just from dollar. That's going to be a global repatriation, or majority of that will be on yen. And where does that take dollar yen to?
It's definitely partly linked to the yen. We've tried to figure this out a little bit. Like, does the euro rally if the carry trade unwinds? I think one of the ways to do this, you can look at the BIS data, you can try to look at positioning data, you look at valuation data. I think one way we do it, which is unique, is we run FX portfolios, and those portfolios assist in our understanding of what's driving markets. If you look over the last 5 years, one of the best performing strategies has been the carry trade. So if you kind of look at the performance of the carry trade in the short term versus kind of the longer term, what we're kind of seeing is that with the high Sharpe ratios that were delivered on a carry strategy in FX, this is not something that just, hedge funds get squeezed out of in 1 month and then the whole thing is done. So I would say we are measuring carry trade in terms of trillions of dollars. And those trillions of dollars are driven by the will be driven by the repatriation of Japanese that have pushed investments abroad. I would consider a pension fund investment into U.S. tech as a form of a carry trade, along with people, again, having to use currencies on an hedge basis to allocate those trades. So I would say, again, yes, we are talking about months and quarters of carry unwind, not just, squeeze. And again, I think that's partly driven by the performance of the strategy, which has been one of the best performing strategies that we see across our factors. And it's one that once it does well, it attracts more flows into it until the system changes.
Hey, Mark, this has been interesting as always. Thanks for joining us this morning. Mark McCormick of TD Bank. Okay, coming up, Prime Minister Netanyahu has been doubling down on his ceasefire terms with fresh pressure from Israeli protesters. We're going to have the latest for you next.
We say yes, they say no all the time, but they also murdered these people. And now we need maximum pressure on Hamas. I don't believe that either President Biden or anyone serious about achieving peace and achieving the release would seriously ask Israel to make these concessions. We've already made them.
A defiant Israeli Prime Minister Benjamin Netanyahu, he's standing firm, even though protesters have been taking to the streets, demanding a ceasefire in Gaza. Those protests spurred by 6 Israeli hostages who were found dead over the weekend. President Biden then told reporters in Washington that he planned to speak to Netanyahu eventually, with the Washington Post reporting over the weekend that the U.S. plans to present a take-it-or-leave-it ceasefire deal to all parties soon. Joining us now for more is Bloomberg senior editor Bobby Ghosh. Bobby, at what point can Netanyahu no longer be defined? At what point does he actually need to listen to the protesters?
Well, as long as the protests are coming from the left, and that seems primarily to be the case, he can hold out. What needs to happen for him to change his position is for there to be a split within his right-wing, hard right-wing coalition. We haven't seen that yet. As part of his governing coalition, those parties are still very much behind. In fact, they are, in some cases, to the right of him. They want even more military action against Hamas, against Gaza, and in the West Bank. So as long as that consensus holds, his political position does not change. But this is a man, famously, his 9 lives, but you have to now think that he's down to maybe half of those lives. That he's exhausted 8.5 of them. These protests are very serious. They're the largest protests since the 7th of October. Hundreds of thousands. There was a strike that only lasted half a day, but it's a significant shot across his bow. What we have to see now is whether any of those right-wing parties now stands up and says, this has gone far enough.
Do you get a sense from Biden's one-word answer in terms of is Netanyahu done enough? No. Is something shifted in the U.S. spectrum?
No, I'm not yet convinced that the Biden administration is prepared to go any further than it has. This take it or leave it plan essentially has been on the table since the end of May. And for whatever Netanyahu says, there is consensus in Israel and in Washington that it is Netanyahu who's standing in the way of the ceasefire deal, much more so than Hamas. The British have gone a little farther ahead than the U.S. They've announced the suspension of some arms sales, not a great deal. That creates an opening for Biden. If Biden wants to follow that example and even sort of issue a temporary block on some arms sales to the Israelis, I suspect that is the maximum that they will be prepared to do. And even that, I'm not so sure.
I just can't help but wonder if we're in a scenario where an American citizen has died. One of the hostages was a U.S. Israeli-American citizen. If there's an unwillingness from the Biden administration to do something like that, because if this doesn't cause it, then what would?
Well, what you heard from Netanyahu, there is sort of a preemptive strike at Biden by saying, I don't think President Biden, if he is serious about permanent peace in the region, would ask us to make these concessions. So he's sort of saying back off. And that word that Biden used, ultimately, that he'll speak to Netanyahu ultimately, that's not strong language from the American president. So it would appear that even the tragic death of these 6 Israeli hostages, the fact that they happened only in the last 48 to 72 hours means that if a ceasefire agreement had been arrived a week ago, 2 weeks ago, a month ago, 2 months ago, they would be alive and potentially at home with their families today. That's a very powerful piece of knowledge for folks in Israel to have. And the anti-Netanyahu protests will try to build on that. But I don't think that's moving any needles in Washington.
In terms of the negotiation, from all sides, there's going to be a number of points that they want to win on. Where are we in terms of Israeli forces remaining on that Gaza border, that Gaza-Egypt border? Is that one of the biggest sticking points?
Yeah, that's the biggest sticking point. It's called the Philadelphia corridor. It's the border between Gaza and Egypt. The early drafts of the plan that the Biden administration put forward basically required Israel to withdraw from all of most of Gaza, including the Philadelphia corridor. But Netanyahu came back and said, no, we want to stay there. And that seems at the moment to be the biggest sticking point. He's adamant that he's not going to get out of there. Hamas is insisting that they have to, because that's the sort of pivot around which this entire deal now turns.
Bobby, we really appreciate your time this morning. Bloomberg's Bobby Ghosh. Okay, let's get a quick check on your commodity market this morning. We are looking at weaker both Brent and iron ore and copper, down some 3 1/3% for iron ore. Manus, Goldman out with a new forecast.
Yeah, they're basically saying, look, there's limited upside for steel in China. The environment for iron ore remains challenging. And we've heard this from some of the biggest steel producers in China last week, 10 days ago, talking about this is 2008, this is 2015. So that's the state of play within the Chinese economy, and certainly taking iron ore lower.
Yeah, and it's a problem because Goldman had been one of the biggest cheerleaders of the industrial metals. But yeah, they've cut it by almost $5,000 a ton. Okay, Manus.
It is a big week, as Danny and I have been saying for you, in terms of jobs, jolts, jobless claims. It is a feast along with manufacturing and services. We bring it all to you here on Bloomberg. Good morning from New York.
It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's get you set up for this trading week, a shortened traded week. Manufacturing PMIs, those come out at 9:45 a.m. Eastern. They'll be followed by ISM manufacturing at 10 a.m. And then it is a marathon of data, specifically jobs data. We're going to get jolts on Wednesday, ADP and jobless claims on Thursday. And then finally, Manus, it is the big one. We're going to round out the week with U.S. payrolls report on Friday. 165,000 is the current estimate.
Yeah, let's hope it's not deja vu from the start of August, where it was a little bit of a jolt from the blue. A couple of stocks to keep an eye on. Boeing, as I said at the start of the show, Wells Fargo slashes or downgrades the stock, setting a street low target of $119. We're at 169 and change at the moment. U.S. Steel, perhaps the most important point, is Harris yesterday on the campaign trail saying U.S. Steel should remain American-owned and run. But Danny, it's dollar-yen. It's almost like a redux of the beginning of August. We've seen the strength in the yen. UADA writes a letter to the government going, I'm still for hiking rates. There you go. A little bit of a leg higher for yen, lower for dollar.
Yeah, and it's up nearly 1% versus the euro this morning. It is a UADA saying, look, we are going to be hiking should, as you say, the economy and inflation data hold up. But it is not a BOJ that has been spooked by market volatility. And that's what many traders had hoped for. Instead, we heard from Mark McCormick of TD saying that he does expect this continuous unwind of a carry. That is not that it all goes at once, but it's a slow moving progress of hike after hike, eating away at the ability to hold yen as a carry trade.
Just to coin what T. Rowe Price actually said, they called this yen carry trade unwinding the San Andreas fault of finance. Mark McCormick at TD says it's going to be quarter after quarter. It's going to be trillions of structural repatriation from U.S. assets. People who bought tech, this is the interesting point, people who bought tech stocks, funds that bought tech stocks essentially as a carry trade, buying the dollar asset, funding it in yen, and that's got a big consequence for the bigger tech play.
Yeah, we hear this all the time. I still have yet to meet a fund that's actually done this. I want to hear from them. I literally have not heard anyone actually doing this.
Give us a call. You're very welcome to come on the show. It's the end of your day, but you're always welcome.
Yeah, I think that's a good invitation. All right, it's a busy week. Surveillance takes the reins from here to walk you through it all. This is Bloomberg.